Whenever the Sensex and the Nifty touch a new high, it creates confusion among investors. Some think of stopping their SIPs and some even think of totally exiting from equities. In this video, I will be sharing with you the views of 7 veteran investors on what they think about the current stock market situation. And in the end, I'll share how I plan to implement their advice at a time when the Nifty 50 is at record levels. And if you want to become an early investor in this microcap channel, you know where to click. Namaste and welcome to Retail Investing. Mr. Prashanth Kemka of White Oak is cautious of the rally in the small and mid caps. Mutual funds have been pouring in a lot of money into the small and the mid caps, which took their valuations to record levels. This cannot be expected to sustain. Mr. Kemka also feels that whenever markets cross an all-time high, it is not necessary that it will be followed by a correction. But whenever corrections do happen, it starts with volatility. Volatility is seen when the battle between the bulls and the bears becomes indecisive. The 12th of September was the first day of noticeable volatility after 5 months. Mr. Kemka expects more volatility in the future. The next one is one of my favorite investors, Vijay Keria of Keria Securities. He is extremely suspicious of the sudden interest in small and mid caps. Even though he himself is a small cap investor, we are all familiar with large caps, mid caps, small caps and micro caps. Keria ji talked about a 5th category of stocks, the Bhangar caps. Now you may call them whatever you like, the scrap caps or the junk caps, but they are the penny stocks. Whenever markets touch a new high, it is likely that new buyers have emerged. Often these new buyers are inexperienced retail investors, and the Bhangar cap penny stocks grab their attention. A 5 rupee stock becoming a 500 rupee stock seems logical to them because they already know a lot of stocks trading above 500 rupees, and those stocks must have been worth 5 rupees in the past. That's the default logical fallacy that we all have to deal with. Newcomers in a bull market often get tempted by the Bhangar cap. Keria ji also believes that New India's long bullish party has just begun, but there may be few hiccups on the way. He is basically warning novice investors against ending up buying high and selling low. An easy way for new retail investors to avoid that is by keeping a long-term view and doing cost averaging instead of lump sum investing. Mr. Sunil Singhania of Abacus Asset Manager believes that the world is ready to bet on India's growth potential. He thinks that the foreign institutional investors will become long-term investors in Indian stocks. Mr. Singhania expects that in the next 2 to 3 years, foreign inflows into Indian equities will be very high. If that really happens, the Nifty can continuously keep hitting new highs in the next 2 to 3 years. Mr. Sandeep Tonn of the famous Quant Mutual Fund believes that value stocks will outperform the growth stocks in this decade. And this is going to happen not only in India but also globally. Some examples of the growth stocks would be companies like Tesla, Meta, and the new age Indian companies like Policybazaar, Paytm, Zomato and Nykaa. Let me explain in short the widely accepted concept of value and growth stocks. Valuation of the growth stocks are done purely based on their future potential, and their present financial conditions can be ignored, which may be bad. Value stocks are of those companies which are currently trading below their real worth suggested by their financials. Warren Buffett disagrees with this classification. According to him, value comes from the growth of future cash flows. The quant mutual funds, as the name suggests, use the quant style of investing. The quant investors are some sort of financial engineers who use quantitative data analysis to outperform the market. One issue with traditional value investing is that the market may not recognize an undervalued stock for years, and the price may not move for several years. It looks like Quant Mutual Fund's VLRT model tries to solve that problem. V stands for valuation, and at its opposite is placed liquidity. Good liquidity in an undervalued stock could mean that the market is starting to recognize its real value and price appreciation is on the cards. It's actually quite impossible to know what their quant algorithms really do to generate such high alpha. So as a retail investor, what should I do? Probably keep chasing value instead of price. Mr. Nilesh Shah of Envision Capital believes that India's macro and micro situations are amazing, and together they are going to massively benefit investors in the long term. He is heavily bullish on India in the long term because of the country's macroeconomic strength relative to the global macro environment. But he advises investors to exercise caution in the short term due to factors like crude oil prices. Mr. Mark Matthews of Julius Baer is confidently overweight on India, and he thinks the markets will continue to go up. And his reasoning is interesting. He thinks that local funds and not foreign funds will drive the rally. You and I are the source of the local funds. and our SIPs. In the last few years, both the amount of SIPs and the number of demat accounts have grown very fast, and the rise in per capita income will continue that uptrend. The working age population is growing, and many employment providing sectors like IT and technology are paying higher salaries. These high earning people are expected to invest in equities with discipline to fulfill their retirement plans. The same thing is already happening in countries like Australia and Malaysia. Mr. Saurabh Mukherjee of Marcellus is cautious of the optimism in the PSU stocks. According to him, the growth in the PSU stocks is driven by government capex, and government capex is not sustainable in the long term. Mr. Mukherjee is positive about high-quality IT companies and financials because their valuations seem reasonable. He believes that there will be sustained foreign inflows into Indian equities over the next few years. That would result in the NIFTY keep touching new highs. So instead of tracking the market movements, retail investors should find good businesses at the right valuations and hold them long-term to enjoy the benefits of compounding. So after studying the viewpoints of all these people, I have decided that I won't try to time the market and continue doing my SIPs, but avoid lump sum investment at the moment. However, if I find any potential multi-bagger small cap stock using the bottom-up approach, I would do lump sum investing in it. But I would avoid the small cap and the mid cap indices or mutual funds, and definitely avoid the bhangar caps. During bull markets, there is too much optimism and euphoria, and people get too much excited about passive income coming from equities. Ignoring your source of active income in hope of passive income could be a disaster. My active income is my job, which has become a pressure cooker these days and preventing me from researching and making videos. But I cannot imagine ignoring it, because active income plays a very important role in the journey towards financial freedom. And lastly, I would like to mention that I will never take on debt to ride the bull in the stock market. Now don't forget to type in the comment section, how do you plan to invest when Nifty is at record levels? If you found this video helpful, please like, subscribe and share. Thank you very much for watching, and I'll see you in the next one. Jai Hind.